Good morning, all, and thank you for coming, and thank you for the invitation. I want to extend my appreciation to Jeremy Hill for asking me to come here. He asked that I come and talk about the U.S. economy, the global economy, and also the financial markets. And I said, wonderful. People want to listen to me for 4 hours? And he said, no, Paul, it's a half hour. I said, I can't do it in a half hour. He said, and this is where being a great administrator and diplomat comes into play. He said, gave me the compliment. He says, Paul, thank you for volunteering, but if you don't do it within a half hour, we're going to cut your pay. I didn't know what that meant, but I got the hint to leave it to a 1/2 hour. What I would like to do is first talk about the economy, because that's really what drives the financial markets. And getting a good, strong understanding of the U.S. economy, and also to some extent the global economy, will help identify where there are good places to invest and things you can think about for your own investment portfolio. And when you first take a look at the U.S. economy, I first want to talk about GDP, because this is the broadest measure that we have of the U.S. economy. It measures all the goods and services. And as you can see here from this chart, right now, this expansion that we're in is the second longest we've had since the end of World War II. By next July, it will be the longest, and which is a pretty big thing. Now, the important issue to remember when it comes to expansions, they don't just die of old age. There has to be something that causes it. Sometimes it's a spike in oil. Sometimes it's geopolitical issues. In most cases, it's the Fed. The Fed raises rates too quickly, and as a result, it causes a recession. There's a famed economist at MIT that talks about that, saying that expansions don't die. They are murdered by the Fed in their bed because they just raise rates much too much. But where we stand right now, close to 10 years, is important. And it can keep going. And our view is that this expansion can continue for a very long period of time because we don't have many of the imbalances that we've had in past expansions. Right now, Australia has the record longest expansion. It's at 27 years. They surpassed the Netherlands, which is at 24 years. So assuming that there's no policy mistake by the Fed, assuming we don't get a spike in oil, assuming we don't have some major geopolitical risk out there that could cause a problem, this expansion can continue for some time. Because a couple of the other issues that are going on that's really attractive about this expansion is the fact that the unemployment rate has had the largest drop of all expansions we've been through the end of World War II. And the inflation rate's among one of the lowest that we've had in all the expansions since the end of World War II. And this is nice in the aspect that if the inflation stays low, then there's less of a risk of the Fed over-tightening. And this expansion can continue to move on forward and forward. Now, this chart here just shows what GDP looks like. The columns represent the quarterly change. The line represents the year-over-year change. All of it's annualized, so it makes it easy to compare. But you can see in this expansion that this economic expansion has been growing only about 2 to 2.25%, which is relatively slow compared to what we've seen in past expansions. And this is an important issue for many politicians that are trying to run stimulus programs. But it's also an important thing to keep in mind, the fact that it's okay to have this little slower rate of growth, because what we have right now is doing extraordinarily well based on where we are in the world, what the demographics are, and so forth. Another way to take a look at how the economy has performed is to take a look at it in a longer text in terms of decade by decade, which I will to in a moment. But the important thing to keep in mind here is that this growth that's at 2 to 2.25, you hear economic numbers quite a bit, and the GDP is the most important of all. But it's history, it's old numbers, it's not forward-looking. But it's important to give us the base of where we are. And understanding that where we are at this 2 to 2.25 is important. Because from the period of time from the end of World War II all the way to the Great Recession, this economy averaged 3.5% growth. And to put these in perspective, the GDP numbers are like driving a car. When's driving a car most fun? It's when you're in third gear, picking up speed, and you get to shift into fourth gear. If you have the roof down, it's even more fun. But that's the sort of growth that the Fed would like. That's the sort of growth that the administration would like, that 3 to 4% growth, because that creates a lot of high-paying jobs, but it's not so strong that the Fed has to come in and push up interest rates and choke off the expansion. But this growth is, as I said, 2 to 2.25. It's like driving a car in second gear. It'll get you to your destination, but it's not optimal. And this is the reason why we're at a much slower rate of growth. Here we're taking a look at GDP in terms of the dollar value from the 1950s all the way to the current period of time. And I've broken it down to show the performance of each one of those decades in terms of the growth. You can see that we used to have much faster rates of growth than we have right now. In the 50s, we were the manufacturer of the world. You know, the GI Bill came in and up until World War II, this was pretty much an agrarian economy. Post-World War II, things like the GI Bill trained people to work on an assembly line, and by doing so, they created much more economic output. So that's what drove the economy. So in the 50s, we were able to have strong growth because we were the manufacturer of the world. In the 60s, Western Europe and Japan started to get back online, and they were competitive against us. As a result, what kept our growth strong? Well, there are two ways to add growth to an economy: increase the labor force or increase productivity. Both were happening in the 60s. Women were coming into the labor force, and productivity advantages started to increase. I mean, things that you think of being ubiquitous now, like the photocopy machine. Well, that replaced what was then secretarial pools, where you have 20, usually women, all typing memos. That doesn't create much economic output. Put in a photocopy machine, those women could go off and do other jobs that created much more economic impact. And we saw that in the 60s. In the 70s, we had strong growth. And that's because the first wave of the baby boomers started to come into the workforce, and women kept coming into the workforce. In the 80s, that started to taper off a little bit. But in the 80s, we had something new. We had things like home equity loans, junk bonds. The federal government started running large deficits. There's even a faster way to grow an economy. It's spend $110 for every $100 you have. The balance sheets were all levered up, and that's what grew the economy at that point. In the 90s was the period of time where we had the longest expansion. We didn't have a recession. If you recall, in the 90s, when Alan Greenspan was the chairman of the Fed, the general belief was that we've mastered the business cycle. The Fed can prevent all recessions in the future. Well, it didn't quite work out that way, but that was the belief, and people would spend quite a bit. But it started to change in the 2000s. You can see how it dropped significantly right before 2010. But even before that, if you look at the period of time of 2000 to 2006, growth was only about 2.6%. And this expansion, a little over 2%. It's slowing down. Now, this is a bit of a surprise because when you look at the economy, these are indicators that we look at as asset manager. There's 20 of them that we look at. The key theme here is that you see they're color-coded. Most of them are green. 17 of them are green. If you looked at this back in 2008, the majority were red. But the economy is doing so well, why aren't we getting that strong growth? And what's even more surprising is when you take a look at what the Federal Reserve expects going forward. This chart here is showing the year-over-year change of GDP, and it also shows what the Fed is expecting. Now, since this was sent to our compliance group and sent here, the Fed's revised the numbers a little bit. They expect growth this to be 3.1% this year, but the consistent theme is they expect growth to taper back down to about that 2 to 2.25%. And the main reason for this is you need just a quick understanding of what GDP is. If you remember your high school or college economics, you can remember it's government plus investment plus consumer plus trade. Those are all the factors that go into GDP. But it's the consumption, which makes up 2/3 of GDP, is the driving force. And this means going out to breakfast, going to the dry cleaners, buying a house, buying a car, going to the doctors. Consumption drives this economy. And the U.S. economy is very fortunate this is the driving force. This allowed us to come out of the recession much faster than most other countries because we weren't reliant on other countries buying our goods. We were just reliant on ourselves. But this is the driving force, and consumption is changing. This chart here shows consumption on a year-over-year basis. The columns represent the recessionary periods, but you can see a common theme from the 1980s to the present. The amount of growth of consumption continues to fall. The 1980s is when baby boomers were at their prime spending. They had kids. College is expensive, but those first few years are really expensive. All the stuff you need to schlep them around and, a bigger car, maybe a bigger house in addition, all that sort of stuff drove consumption. It's also the period of time when the home equity lines became new and available, right after the deduction of credit cards was taken away. So it was a boom for spending. But as the baby boomers continue to get older, their spending habits have been reduced. And now that they're getting close to retirement age or already into retirement, they're not spending a whole lot. The millennials who are coming in are much different than baby boomers. Millennials are much more like the parents of baby boomers. Those that lived through the Depression, those that lived through World War II. They were far more frugal and far more cautious about the future than the baby boomers. The baby boomers lived through a magnificent time of an economy, all those factors that I talked about. If you lost your job, you probably got another one, and your quality of life continued to improve. Millennials are looking at things much differently. They're not so eager to go out and buy a house and fill it with stuff. That's what drives an awful lot of consumption. They're not interested in levering up their balance sheet like their parents. They want to keep leverage low. And as a result, if you've got a drop from about 4.5% GDP back in the 80s to a little over 2% now on 70% of the economy, right there, the simple math is you're taking away 1 to 1.5% of GDP. That's why the economic growth is so much slower than it had been in the past. It's because of consumption. And we don't see that changing a whole lot. Now, in regards to the Fed, the most important thing to pay attention to is two things: the labor markets and inflation. That's their statutory requirement. So here, I'm going to just buzz through these charts. I've got an awful lot of charts, so buckle in and we'll focus and get this stuff done. But this is my favorite employment chart. This just shows the aggregate change of employment month after month since the worst of the recession. Look how linear that is. The employment market is extraordinarily strong. On the left side shows the unemployment rate down at 3.9%, and this chart shows it all the way back to the 1950s. The only times that it was substantially or significantly below this level was in the early 50s and the late 60s. In the early 50s, a lot of our labor force was overseas fighting in Korea. In the 60s, it was Vietnam. It's extremely rare to have this sort of level of unemployment. The chart on the right is the powerful chart. You can see the unemployment rate is below what the Fed thinks is full employment. When it gets below this level, this means that it gets expensive to hire people. So wages are just starting to move up in this scenario. The chart on the left here shows the amount of job openings versus those that are looking for jobs. And at the first time in the history of this series, there are more job openings than there are people available to fill it. And the chart on the right is the quits rate. This is the number of people that are voluntarily leaving their job. This tells you a lot of things. One, they have the confidence to leave their seniority and comfort of their current job to pursue something else. But more importantly, when you get another job at another firm, what normally happens is you get a big bump in your compensation. So we're seeing this, and this is at the highest level it's ever been. The unemployment rate, in terms of what the Fed thinks, again, the line shows where it's been, and the expectations, the median expectations going forward. The Fed thinks that the unemployment rate will continue to stay low. Another way of saying that is this expansion will continue to stay relatively strong. Inflation, the Fed put on a target of 2% inflation back in 2012. There are two main metrics for looking at inflation. CPI is what many people are familiar with, but there's another one called the Personal Consumption Expenditure Number, or PCE, and this is the one that the Fed pays attention to because the CPI has too much of a weighting for housing. Here, it's been around 2%. It's not much of a problem, and it's not expected to be much of a problem going forward. In terms of when you break down inflation, 2/3 of it is geared towards services, going to the dentist, the dry cleaners, that sort of thing. 1/3 of it is the cost of goods. And you can see that the services part has been relatively strong and consistent, which is good, because 85% of the workforce in the United States is in the service business. If you can get pricing power here, you're more willing, and you're expanding, you're more able to hire more people. The goods part, that's things like gasoline, lumber, copper, that sort of thing. Commodity prices, by and large, have been quite weak. So that's helping to keep inflation down. But the most powerful test in terms of inflation looking forward is what they call the TIPS break-even. What they do is they take a traditional treasury bond, and then they take a treasury security that's linked to inflation, where that's the income that the appreciation is given to the investor. If you subtract the two, the yields on the two, that will tell you what the market thinks inflation is going to be like, all the way out to 30 years. The expectation is that inflation will stay around 2%. It's been at that level since about 2000 or so. The expectation is that it will continue. And the main reason for that is that we're in a different world than we were in the 70s and 80s. In the 70s and 80s, demand was outpacing supply. The world was expanding very quickly and there weren't enough commodities. Now we're in a situation where supply is outpacing demand. And you can see that here in the commodities chart. Commodity prices have been falling for 8 consecutive years. So the inflation expectation by the Fed is that it'll continue to stay relatively stable around 2% over the next several years. So what's that all mean for the Fed? Well, this is a variation from the charts that I was showing you before, but it has a little bit more detail. Again, the line shows where the federal funds rate has been over the last several years, and then the columns represent what the range is of what the Fed members think. The previous charts were all giving you the median estimate of what they thought. The Fed is made up of 7 governors plus the 12 regional presidents, and this makes up the Federal Open Market Committee. They're the ones that decide what monetary policy is. The interesting thing is the further you go out, there's a bigger range in terms of those expectations, which I find interesting. These are all pretty learned people. You'd think they'd be a little bit closer in terms of their understanding of what the Fed should do. But there are 2 different camps at the Federal Reserve Bank. One camp, you can see in terms of if you go out all the way to 2020, the expectation is that the federal funds rate will be over 4%. That's the local Kansas City Fed president. And she's of the belief that if the unemployment rate is going to be low, inflation is going to force its way up. It's done so in past times. They're expecting it going forward. Then there's the other camp at the Fed that thinks inflation stayed low. It's not going to be low. Why should the Fed be raising interest rates? Why? All you're going to do is choke off this expansion. Treat this like the 1990s when the expansion was very, very strong and inflation never took off. The Fed was right in the belief that they shouldn't raise rates, and that's what caused that expansion. So that's the little bit of a fight that's going on within the Fed, but the general expectation is that the Fed will continue to raise rates, and they will do so, and the terminal rate that they project it to be, the median one, is at 3 3/8%, which will happen by the end of 2020. Now, home prices are a big and very important part of someone's portfolio. For most Americans, this is the biggest asset that they own. The general way that it's worked over the last several decades is a family would buy a house, a relatively big one, they raise their kids in it. It appreciates at a pace faster than inflation, and when the kids move out, they can sell it, realize the gain, and that's part of their retirement plan. And that worked extraordinarily well until the housing crash that we just went through. But the interesting thing is that nationwide housing prices are moving up, and they're above the peak of what they were before. This chart here shows it all depends on where you live, though. Wichita, it's not here. It's not considered one of the top 20 cities, but for some reason, neither is Houston, which is the 3rd largest city in the country. That's not listed there either, which is okay until you give a speech in Houston where they say it's not there, but Dallas is. That said, there's an important theme that's going on in terms of these housing values. You can see the ones at the top of the chart. These are where young people are moving to live in an urban area. They want to live in cities like Denver, San Francisco, Seattle. They want to live in places where there's colleges right in the city, important colleges, mass transit, and a young dynamic group. And those houses are very expensive to create. Just how expensive it is for city land and all the infrastructure that needs to go in. So that's why those prices are much higher. The ones at the bottom, that's generally where older people are going to live, where there's tons of space and excess capacity. But it all really makes a difference in terms of where you live. The interesting thing about housing, and this is a bit of a complicated chart here, but this shows the housing starts over time because this is really the driving engine of them all. You can see it moves around, but the average has been about 1.5 million new homes per year since the 1960s. You can see that since the recession, it's been substantially below that. And the reason being is that millennials just don't want to buy a home. They don't want the McMansion in the suburbs. They want to be in an apartment. They don't want to lever up their balance sheet. It's also harder to get a loan than it was before, but it is changing the demographics. Again, this is one of the driving forces in terms of why consumption is quite low. And you can see that here in this chart, single-family homes versus multifamily that are being constructed. Single-family homes are nowhere near the level they were in the past expansion. Multifamilies, these are the condominiums, these are the apartments, those are back at the levels. That said, single-family homes are starting to move up, and you can see that. And that's because the millennials are getting older. I joke about this. My wife and I my wife wanted to stay in the city, like European living, be close to your neighbors. It's a great community. So we had this two-bedroom flat. And, once two kids got old enough to start talking and talking back with opinions, boom, we were out into the suburbs very quickly. But we'll probably see that move. It's just doing it at a little slower pace than what we've seen in past expansions. In terms of the dollar, here's the dollar over time. When Nixon took the dollar off the gold standard that started trading against other currencies, you can see what the average is. There were periods of time where we were above the average, and that was in the late 70s and early 80s, and that, of course, was when money market funds were paying 20%. Investors were putting their money into the United States to do that. It got above that average again in the late 90s, early 2000s. Again, there was the dot-com rally. But right now, the dollar is relatively fairly valued. It's done well this year, but it had a horrific year last year. The expectation is that it will continue to do well, but not nearly at the pace of what we've seen in the last 6 to 9 months. The biggest issue here is the deficit, and this is the biggest risk, probably long-term risk to the U.S. economy. The chart on the left shows the value of the deficit versus GDP, and it's important to measure it versus the economy because that way you can do it on a historic context. You can see back in the World War II, it was up around 120% of GDP. It was very expensive to run a war. It moved down all the way to about 35% of GDP into the early 80s, and the reason for that was the economy just outpaced the growth of the deficit each year. Then in the 1980s, we started having very large tax cuts and started spending an awful lot more. And it's now, you can see the worst of the recession. Most of that was because of the loss of tax revenue coming in. But the chart on the right just shows the difference between expenditures and revenues, and you can see how it's really changed in the last 30 years from what it was before that. It's really quite significant. Another way of taking a look at it is just taking a look at how much is being spent relative to how much is being brought in. And you can think of it in these terms. It makes it a lot easier. From 1970 up until the Great Recession, we were spending around 10 to 12% more than we were bringing in. So you can think about that in your own life. If you used your credit card and just kept adding on 10 to 12% more than you brought in each year. After a while, something's got to happen. Since the recession, you can see it's gotten a whole lot worse. And the trend has started to shift. The large tax cut that we just had will make the deficit a whole lot worse. It doesn't affect what we have right now, but long-term, the problem is the cost of financing the debt squeezes out other investments. So people don't invest in businesses. They would rather buy the safety of a treasury bond. And this is an issue with the politicians. It's spending money and balancing budgets, not an important issue. I don't keep politicians on a very high pedestal to start with, but long-term, it is a very severe problem for the United States. Right now, we're running a deficit close to 100% of GDP. Above 100% is when economists think it becomes a problem. To put in perspective, Greece is about 140% of GDP. Great Britain's about 85%. Germany's 65%. Japan's the worst. They're at 240%, but they self-finance. But this is all up to, again, the politicians. I don't know if you know where the word politician comes from, well, it comes from the word politic and the etymology of it. It has two roots, poly being the Latin word for many or from many, and tic being a Latin word for spineless little creature that'll suck every ounce of life out of you if given the choice. There are some international issues that are a bit of a problem. By and large, the economies are doing okay around the world. The worst probably is Venezuela. And this is a little bit of a funny chart here to take a look at to try and understand, but this is what a cup of coffee would cost. It was 2,500 boliceros for the longest time, and then inflation has become a severe problem. Spending much more money than they're bringing in, and about 90 to 95% of their revenue comes from oil. They have one of the biggest oil reserves in the world, but they're managing it so poorly that they're only getting about 20% of what they got just a few years ago. Without that money, inflation becomes a problem. Again, talk about deficits. So eventually the inflation got so bad, the cup of coffee was costing 2.5 million boliceros. So the president, along with his son-in-law, who's the finance minister, says, we can fix this. We'll just knock 3 zeros off the value of the currencies. And before that meeting was over, inflation kept moving up. They decided to knock off 5. And that's why the price has plummeted. Just in case any of you decide to become a dictator and have hyperinflation, when you do cut your currency, do it in groups of 3s, either 3, 6, or 9, because The 5 is just too hard of math, and the banks were closed for a couple of days because they couldn't figure out how to do that. But this is what makes me so excited about the U.S. economy. There's a couple of the next few charts, which leads into some of the financial issues. First of all, consumer confidence, you can see, is on a strong upward trend. And a lot of that has to do with the low unemployment rate and the high stock prices. Household wealth is almost 50% higher than it was at the peak beforehand. The problem here is not an equal distribution among the socioeconomic groups, but I hate to use this word, but the trickle-down effect does work to some extent, and wealth is just creating a lot more opportunity, especially with the recent tax cuts, especially for businesses and especially for investment. This should help drive the economy going forward. But this is my favorite chart of all. This is the leverage that I've been talking about, household leverage. You can see how it moved up in the 80s when home equity loans became popular. In the 90s, it was relatively strong because there was no look at a recession. But look at the Great Recession and what's happened, the sharp drop that occurred. Roughly a third of that was people walking away from their cars, walking away from their homes. You know, no faster way to clean up your balance sheet than walking away from it. The other 2/3 were people wanting to just reduce the leverage that they have. And despite the strength in the stock market, despite the strength and confidence, despite the wealth created in so many different areas and the low unemployment rate, Americans are not leveraging up again. And if you're not levered up, then the increase in interest rates won't affect you nearly as much. Again, baby boomers are too old. They don't want to be leveraging up their balance sheet. They're far too worried about retirement. Millennials don't want to lever up at all. Again, they're like the baby boomers' parents. Now, let's start talking about stocks quickly. Here we're taking a look at corporate profits. This, to me, is a marvelous story because corporate profits is what's really been driving the stock market. And take a look at this chart. It was relatively stable until the 1980s. It's really at the 80s that it started to take off. But I was having a conversation with a client about this. Think about things in the 1980s. Would you invest in the stock market in the 1980s, not knowing what the future was going to be like? Well, you know, just like this time right now, you don't know what the future is going to be like. But what if we go back to 1980s? And I said, would you invest knowing that we're going to have 5 recessions? One of them is going to be so severe, it's going to be compared to the Great Depression. You'd probably say, no. I said, but what if economic growth tripled all the way to 2018? Would you invest? And you say, well, maybe. That sounds good. And I would say, what if I told you there would be an attempt on one of the president's life? Would you do that? No. What if I told you they would impeach and try to remove another president from office? You'd say, no, I would not do that. I said, what if I told you about the Kardashians? Would you invest? You'd probably say no. But in 1980, the stock market, the S&P 500, was at 100. It's around 2,900 now. The ingenuity of the Americans, of American businesses in terms of being able to find ways to create the better mousetrap is phenomenal, and it's nowhere else in the world. And yes, we are being attacked in so many different ways to try and figure out how other people can get shortcuts to get to it is happening. But I have a great deal of faith in terms of what can be done here in the United States. So I'm quite bullish on the U.S. economy and the financial markets. Here we're taking a look at stock prices. If you remember on the speedometers that I showed you, stock prices are relatively highly valued. This is not the best of the indicators to determine a relative value for stocks, but it is a pretty consistent one that people tend to look at. And they're relatively high, but they're not extraordinarily high. In terms of the different sectors of the economy, what's done well and what's done not, you know, this determines you in terms of an investor. If you're one that really doesn't care about investments a whole lot, but you know you have to do it, then buying an index fund makes a lot of sense. But by buying an index fund, you're buying the winners and the losers. There are ways to go ahead and access and overweight certain areas of your equity portfolio that do quite well. Information is one that does extraordinarily well. That is the future. That's where all the advances are going to be made. That's an area that we overweight in terms of our clients' portfolios. The other one is consumer discretionary. This is when you have a little extra money and you can decide what you want to buy. Well, with all this economy doing so well, that's another sector that's done extraordinarily well. One of the worst, of course, is energy, and a lot of that has to do with the period of time here that we're looking at, where oil prices have been. This one here shows the different markets that are around the world. And the way to read this is that since the end of recession, how have they changed and how have they performed? At the very top, you can see it's the NASDAQ. Well, that's where all the FANG stocks are: Facebook, Apple, Netflix, Google, and so forth. The worst, of course, is going to be the emerging markets. And mainly because the emerging markets are really heavily based on commodity prices. And as the chart showed earlier, commodity prices have been falling for 7 or 8 years. Plus, all their financing tends to be done in the dollar, and they've had a weak currency. It makes their financing very, very expensive. And then there's a whole litany of changes that are going on in between. But the important thing, like I just mentioned, our view is that the best places to invest are the sectors that are going to deal with the technological advances going forward, because that's where the corporations are looking to buy products to help give a great deal of wealth. In terms of the bond market, the same sort of thing has been going on here. You can look at the different performance. With inflation being not much of a problem, buying a longer-term maturity, whether it's a CD or a bond or whatever you're doing, makes a lot of sense to us, and lock in those yields and get a little bit higher yield. And moving down the credit spectrum also makes an awful lot of sense, because the economy's doing well. Those corporations or those municipalities won't have much problems servicing their debt. The important thing to keep in mind is that you want to stay invested. Too many times you hear about a high in the stock market and you say, okay, I'm getting out because it can't go much higher. They've been saying that since, like I said, in 1980, the S&P 500 was at 100. It just marvels me to see how much it keeps getting new higher and higher and higher. So it continues to do well. Our outlook continues to be quite good. Profitability from corporations should be quite strong. And that the economy should continue to move. Our view is very close to that as the Fed, that we will get growth and it will continue around that 2 to 2.25% range. But the most important thing in terms of really knowing the future is really which way interest rates are going. That drives everything. The interest rate decides whether you're going to buy a car, in terms of whether you're going to get a house, whether you can refinance the house, which will give you savings. But over the years, it's very difficult to forecast interest rates. But there's been one telltale way of being able to do so, and that is the height of the head of the Fed, of the Federal Reserve Bank. In the 1980s, if you recall, overnight rates were around 20%, and the head of the Federal Reserve Bank was 6'9". Well, he was replaced by someone who was 5'10", and rates started to move down. He was replaced by someone who was 5'7", and they moved down even more. And then finally, Janet Yellen at 5'3". Had the very low interest rate. So Jay Powell, who's the head of the Fed, is around 5'10", so you can expect them to move up a little bit. So, thank you all. It's been a treat being here.